everybody. Welcome to another episode of the Moving Markets Podcast. I'm Jeffrey Dunyan, owner and founder of Safe Option Strategies. It is Thursday, the 14th of March, 2024. The U.S. stock market just closed a few seconds ago. We're going to record the podcast right now after this introduction. So probably be about 30 minutes after the close of the market that we get everything put online. But really interesting day today. The market behaved on PPI data much more like I would have expected it to behave on CPI data. The data came in with much hotter inflation than what was expected. Some of those numbers a bigger jump than what we saw in the CPI numbers. In addition to that, you had retail sales numbers that missed a little bit, and that's kind of a double whammy for the markets. So we're going to talk a little bit about that and talk a little bit about the broader economic picture as we move into spring and not too far away from the summer months. Everybody that's been in the market for very long has heard the old adage, buy in May and then go away. Summer tends to not be as good for the stock market. I think we might be in for a little bit of a downward movement prior to that. So we'll talk about that and some other things. Hope you enjoyed today's episode. Make sure you check us out at sostrades.com. See if there's a package that is right for you as far as some of the membership packages that we sell. As of the close of the market yesterday, we were up 37% on the trades that we send out to members of our program. And we're not even 3 full months into the year. Imagine that 37% 4 times over if we can keep up the pace of what we're doing. We still have 2 full weeks in the month of March that we can add to that. So off to a fantastic start. We look to keep adding to it. Make sure you become a part of that. Members of Safe Option Strategies programs get our weekly trades that we send out. And if they follow them the way we send them out, they're doing phenomenal to start this calendar year. So make sure you check us out. In the meantime, enjoy today's podcast. Good afternoon, everybody. Welcome to our Moving Markets Podcast. It is March the 14th, 2024. The U.S. stock market has been closed for honestly only about 5 or 10 minutes right now. We're getting on top of things and getting this podcast going at a very decent time today. There is some really fun stuff to talk about today. There's some good and some bad. I could go old Clint Eastwood movie, The Good, the Bad, and the Ugly. But let's address just really quickly the most recent couple of trades that we sent out to the Safe Option Strategies members, NVIDIA and AMD. NVIDIA took a little bit of a hit today, but is still in the plus column. We're still profitable in that trade right now. AMD took a little bit of a hit today. They were down bigger from a percentage standpoint. The trade is down overall. AMD dropped down to $185 a share today. I think at one point in time, might have even gone a little bit below that. But I'm not even a little bit concerned with AMD in the respect of feeling like it's going to potentially drop below the price where we need it to stay. We need it to stay at or above 175, and we need it to do that for a couple of weeks, and I'm really not worried about it. So it's down a little bit today. But like I said, NVIDIA is still in the plus column, and I have no concerns or worries about NVIDIA at all. Amazon stock was up today a little bit, but our option prices didn't reflect as much of a movement as we actually got. And Walmart improved today. We're getting closer to our target X on Walmart. So we're looking really good across the board on spread trades. I'm going to put a little plug in for those people that are listening to this podcast that are not members of Safe Option Strategies. Take some time to go to SOS Trades and check out some of the different packages that we offer for membership in the program, because if you were involved from day one of this calendar year, 2024, and following every trade that we did the way we recommend it, that would be the return on your portfolio as of right now today. And it was at 37% yesterday. That AMD trade, a little bit of sell-off there, brought us down just a fraction, but still 35%, and we're only 2.5 months into the calendar year and into the trading year. So things are looking absolutely fantastic there. All right, let's now, I want to shift gears and talk about what happened today, why it happened, and what to expect in the coming week and month. That's what this podcast is mainly about, how to kind of prepare yourself for what is on the horizon, short term and sometimes a little bit long term. So we've been talking all week long about the PPI report coming out, and this morning at 6:30 my time, 8:30 on the East Coast, we got those PPI numbers. Last month, the month over month number was 0.3. The consensus estimate that it was going to be 0.3%. Again, it doubled that. The actual number came in at 0.6. Now, we're talking about fractions of 1%, but we're also talking about double the number that was expected in that report. And that means that the inflation, as much as people would like for it to be in control and potentially over, it's not there yet. And I believe inflation is going to rear its head up a little bit farther for another couple of months before we might see any calming and anything positive take place. The year over year number last month came in at 0.9%. And remember, that's a 0.9% increase over the previous year. So it means inflation is still going up. All this nonsensical talk about inflation coming down, the rate of growth has come down and slowed down, but inflation has not come down yet. It's a very misleading way to report it when you hear people say inflation is coming down. There's a lot of people in the media, there's a lot of people in politics that want to say that. The reality is that inflation, the rate of inflation has slowed down, but inflation is not going down. That year over year number that was 0.9 last month on the reading was expected to be 1.2, and again, came in much higher than expected, 1.6. And while I mentioned it before, I'll mention it again. We're talking about fractional percentages, but we're talking about some pretty big misses here, and these are misses in a direction that we don't want. Now, the CPI data on Tuesday painted the same picture, but for some reason, the markets all rallied on Tuesday. And I'm still scratching my head a little bit about that and wondering why we got a market rally on Tuesday in the midst of CPI numbers that were off. My best guess is that we had a sell-off the day before. People were anxious to buy the most recent dip. In fact, we had a sell-off on Friday and Monday. So I think people were anxious to buy the dip. I think that was a big part of it. I think the numbers were close enough to what was expected that people felt okay about it. And I mentioned in the podcast on Tuesday afternoon that maybe what it did was gave a little bit of clarity to people who were wondering, is inflation going to raise back up? Are we going to creep back up, or are we going to be okay? I think there was a little bit of clarity on that. But today's PPI numbers did not have that same effect. The market did what I would have expected it to do on Tuesday with the numbers that weren't so good. Today, not only was it the PPI numbers that came in worse than expected, but you also had retail sales. There was an expectation that retail sales year over year were going to be going up. Last month, the number that was reported was a -8, a little bit of contraction in retail sales. They revised that to -1.1 instead of -0.8. The consensus was that this number would be up 0.7%. It was only up 0.6%. And that's not the kind of number that people were looking for. When you take out vehicles and then you take out vehicles and gas, the number looked a little bit better, which means that the price of fuel is one of the things that is driving retail numbers, and people are spending more money on that and less money in other areas. So you had a double whammy today with the retail sales numbers not being in line with what economists were hoping they would be, and the PPI numbers being hotter than expected. And this leads us to the conversation about what in the world is the Fed going to do? I believe there are few, if any, people that still think somehow, some way, that the Fed is going to cut rates when they meet next week. They're meeting on Tuesday and Wednesday next week, and I think it's 99%. The market thinking there's a 99% chance that rates remain the same. I'm in that camp firmly. I believe that is accurate. I would be shocked if the Fed announces anything different. But creeping into the conversation now is that instead of 2 or 3 or more rate cuts this year, we may only get 1 rate cut this year. I heard one analyst on CNBC today or excuse me, I think it was Fox Business News, say that he believes there's a possibility now that there will not be any rate cuts this year. And there are a few people starting to believe and starting to think that rates will maybe go up and see one more increase this year if these inflation numbers start going the other way. If you're watching this instead of just listening to it, I'm just drawing my own little graph right now. We had 2021 and 2022 where inflation was going like this, and it peaked in July of 2022. Now you've got inflation going like this, almost leveling off and getting kind of flat, and now it's starting to pick up just a little bit and starting to accelerate a little bit more. But you notice if you're watching this, what you notice on this graph is at no point is it going the other direction. Prices have never been coming down. They are simply not going up as fast as they were. If this was July of 2022 and this was July of 2023, you've got this much inflation plus this much more on top of it over that 2-year period of time. So that's why no matter what the current political administration tries to spin, no matter what they try to get people to believe about inflation improving, prices continue to go up. And wages are going up, but they're not going up as fast as prices. There may be a one-off month there somewhere where it happened, but generally wages are not going up as fast as prices continue to go up. Or at least not overall. Again, there may be some recent months where that's starting to turn a little bit, but if you look at it in the context of the last year, the last 2 years, we're still way, way, way behind. And so real wage inflation is still in the wrong direction, absolutely and unequivocally. So, you've got that. You've got now, the Fed has painted themselves into a corner. No matter what they do now, it's going to look political because I don't think they can lower rates in the March meeting. I don't think they can lower rates in the May meeting. And I'm starting to believe it's going to be really difficult for them to justify lowering rates in the June meeting. And if they don't lower rates until July, if they do a rate cut at all, if they don't lower rates until July, it is going to reek of politics. It's going to be impossible for the Fed to not look like they're being political and that they're, very much in favor of the current administration. And the Fed should be neutral. The Fed should not be making moves based on politics. So, it's a tough situation that the Fed has put themselves in, and if gas prices and oil prices continue to go up, inflation is going to get worse. I mean, it's just all around. We're in a sticky economy right now, and I'm gonna make a little bit of political commentary here because this frustrates me to the point where I've got to talk about it. I don't ever want to drive people away from Safe Option Strategies because they don't agree with my politics. I'm here to help anyone that wants to learn what we do and follow what we do. I'm here to try and help them make money and make a lot of money. And I don't care what your politics are as it relates to that. But I have wondered for the last couple of months and even more so right now, when are the dots going to be connected between what people are feeling in their wallet, what they are sensing in the economy, and how they cast their vote in the voting booth? One of my biggest frustrations is that the only people right now today that are benefiting from Bidenomics, and there's nothing else you can call it except Bidenomics, and in my opinion, Bidenomics is a disaster. It is a complete and utter failure to the bulk of the American people, with the exception of people who are living primarily, not partially, but primarily off government handouts, or people that want the government to take care of them cradle to grave. Joe Biden is out blatantly trying to buy the votes of younger adults by promising to bail out their student loans, to forgive them of their student loans. There's no loan forgiveness. You and I pay the price for that. There is simply a transfer a punishment, if you will, of everyone who doesn't owe money on student loans now, and the way their taxes are going to be affected, and the way they're going to have to pay off the student loans of those people who got crap, worthless degrees, spent way too much money playing around and having a good time in college instead of working and paying as they go, or even if they had to do student loans, they should have been for degrees that were worth something instead of worthless. And now the rest of us are going to pay the price on that. I am hopeful that this coming election sees the dots connected between what's going on in the economy and how people vote. Because if you've heard over and over again, the definition of insanity is if you keep doing the same thing and you expect different results. People that vote Democrat and are struggling with the economy and are struggling with the high cost of food and gasoline and other things, people that are in that mode where they're struggling but continue to vote for Democrats, I can't think of a kind word to describe it. They're idiots. And look, I know there are social issues at play. I know there are things that you might absolutely detest and abhor about Republican candidates, the same way rock solid conservative Republicans hate these things about Democrat candidates. But at some point in time, you gotta be pragmatic, and you've got to say, I may not like this individual, and I don't know of a lot of politicians that I think are squeaky clean, honest people. I just don't. Our political system is corrupt as it's ever been in the history of this country. But at some point in time, you've got to be pragmatic and say, in spite of what I may not like about this person's personality or their background, or I think they're kind of sleazy, their economic policies are going to be better for the country and better for me individually. And can I suck up my pride and swallow it up? And I'm sorry, I'm going to say it, pull my head out of my political biased butt and decide that I need to vote for what is good for the economy and the country instead of what makes me feel warm and fuzzy about a person's personality. Look, there are things about Donald Trump that I don't like. But I don't, with maybe one or two exceptions, you cannot find a politician in Washington, D.C. right now that is squeaky clean, that is not taking money from special interests, that doesn't have skeletons in the closet, that doesn't have things about their life that are, should not put them on any kind of a pedestal. You'll have a hard time finding that on either side of the aisle. But people get so emotionally wrapped up and so emotionally involved in a person's personality that they simply forget about what will this person bring to the table policy-wise, and what will those policies do for me personally and for the country as a whole. And if everyone that was going to vote in this country could set aside their emotions and say which policies are going to improve the economy of this country, Donald Trump would win 99-1 in this upcoming election, in spite of what you don't like about him. And this is not a political endorsement for Donald Trump. This is an endorsement for policies that are going to be better for the economy. Economically, I could get off on some of the national security things with the messed up border. We could get in the weeds about some of the social issues like abortion. There are other things to take into consideration. Not everyone votes 100% solely on the economy, but year in and year out, the economy tends to be the number one thing that people cast their vote about. It rises to the top even when there are other issues that are going on. And if you want a chance for the U.S. to get back to a sound economy, you've got to consider what you're going to do at the ballot box. And I am worried that we have a national media that is so completely entrenched in hard left liberal Democrat ideology that they've lost their ability to report things objectively. They've lost their ability to tell the truth. There may be a little bit of that goes on the right, but it is a disease on the left in the media, that they have an inability to look at things objectively and tell the truth about things. It simply does not happen. And I could give you example after example after example of that. It's staggering to me. So I thought about this a lot today. I knew that if I went this route with this podcast, there would be some people that are very turned off by it. Again, my goal is not to offend you if you're on the opposite side of the political aisle that I'm on. My goal is not to belittle you if you don't think the way I think on things. But it's been bothering me so much lately. If you want a strong economy, if you want to get rid of some of these headwinds that we are facing and some of the rocky road that is in front of us, and believe me, it is in front of us. And if you don't think that, have a conversation with me 3 months from now and see where things are at. Could the stock market continue to do well? Yeah, it could. But the stock market, the indexes, the Dow, the NASDAQ, the S&P, they are propped up largely by a handful of companies that are defying the odds and the economic headwinds. And there's a lot of companies that are not doing that. And in a broader sense, this market may not be as strong as what a graph like this or a chart like this suggests. You can't deny this run up has been pretty spectacular, but it has been on the backs of a handful of companies primarily. And that cannot last forever. Those companies could continue to do well, but they may not be able to do well enough to support the entire index that they're a part of. So I'm going to leave it at that. I'm going to wrap up right there. I think in the upcoming week, the Fed's decision next week, I'm so certain that they're going to hold rates where they're at. I don't think that will have any effect on the stock market next week. But what will have some effect is the questions Powell is going to be asked about rate cuts. And if he has even a small amount of integrity and is willing to set politics aside, he's going to be honest and say, we may not be getting the rate cuts we thought we were going to get this year. We're looking at the data and it's starting to shift a little bit in the wrong direction. And that means that for the immediate future, rate cuts are probably off the table. And what we said about a few rate cuts in 2024, back in October of last year, what we said about that, we always maintained that the data would help drive it. And as the data is changing, we may also have to change what we're going to do. Don't be shocked if that's the commentary. And if it is, you're going to see a bigger sell-off in the second half of next week, regardless of what might happen tomorrow and in the early part of next week. Be extremely cautious with the positions that you have. Don't own stock without being hedged right now. Have some long puts in place. Have a covered call strategy at the very least. And if you know how to collar trade, have your stocks in a collar trade. There's no better way to be in a volatile and downward market than to be in collar trades or be in some very non-directional trades. A handful of our spread trades recently have been more directional. The 4 open spread trades that we have right now are all somewhat directional trades. I'm confident that they're short enough term trades that we're going to be able to get out and move some nice profit. If we see Walmart start to roll over, we may just take the 20+% that we have and get out of that trade. Same thing with Amazon. It's only got a little bit of profit in it, but we may end up bailing out of that if we start to see things roll over. NVIDIA and AMD could be a little dicey. We won't let them get ugly before we make an adjustment or get out. And going forward for the next several weeks, we're going to be very, very non-directional in the trades that we place. We're going to go back to some long iron condors. Our first 4 of our first 5 trades of the year were long iron condors. We included in there a double diagonal and then another long iron condor a couple of trades later. They have all hit good profits, and we're going to go back to that and make sure that as markets continue to get more volatile and maybe shift to the downside a little bit, that we're positioned very well to not worry about, are we pointed in the right direction? We want to be non-directional as we go forward, and you should consider doing the same thing. All right, I hope you had a great Thursday. We'll see you back here tomorrow for our wrap up for the week. And in the meantime, have a great rest of your day and a good day tomorrow.